Hey everybody, thank you for tuning in. Today I want to talk about investing. I want to talk about investing in your early 20s and the impact that it'll have on your life if you start early. And I am in my early 20s. I started when I was 18, and currently I have a net worth of around $500,000. I work in finance and I have a high paying job, over six figures. I just graduated college, and I think that this video will hopefully help a lot of people. I definitely, the goal of me creating these videos are really just to connect with people and try to inspire and point some people into the right direction. And so I hope that this video would do that. Um, Please let me know if you're listening on your way to work or while you're sleeping. I hope my voice is soothing, and if that's value that I'm adding in your life, then I'm happy to do so. But yeah, let me know where you're listening from. Curious. Um, and without further ado, I think it's a good time to start. So when I was 18, I started my Roth IRA, and that is when everything changed. I'm so glad I started early because it's a tax advantage account. So that means that when I'm 59 and a half, I can withdraw all the money that I put into that account tax free completely. Um, and the limit I believe right now is 7,000 a year. Um, and I plan on maxing it out as much as I can every single year until I'm 59 and a half. And I should have, as long as I'm invested in the S&P 500 or a stable ETF, a reliable ETF, that is returning me 8 to 10% every single year, I should have around $1 to $2 million, I believe. But basically guaranteed to be a millionaire at the age of 59 and a half. And so I think everyone should really just, do that, get that account started. Even if you're in your 30s, 40s, 50s, whatever it is, get that tax break, take advantage of the markets, get your money to work for you. And another thing is the 401k. When I started my job, I started to max out my 401k. It's basically the same thing as a Roth IRA. I have a 401k Roth, which means the money I'm putting in is taxed before I put it in. But once I take out the money, the compounded growth over the time that it's been in the market will be completely tax free as long as I withdraw at the age of 60 or 59 and a half, I think. Um, that money will be tax free. So these are amazing, amazing investment vehicles that everyone should max out if they have them available. And so the compounded interest over time on your investments, 8 to 10% a year is the standard return for the S&P 500. Now that doesn't sound like a lot of money, and it doesn't sound like that big of a difference, but compounded over time, uh, you know, y- you're basically taking 8 to 10%, adding on another 8 to 10% on top of that 8 to 10% each year, and that is the power of compound interest. And based on my current projections, whatever I put in the market will 10x, assuming an 8% return once I'm 60. So I'm thinking that every dollar I put into the market now will be worth $10 when I'm 60. Every $100 will be worth $1,000. Every $1,000 will be worth $10,000, and that's a lot of money. Once I grow old. Now there's also money that I put in the regular brokerage account. My personal investment account, and there's not much difference in that account, to be honest, in terms of what I'm buying, what I'm holding. I mainly invest in the S&P 500. I also have a decent amount of my net worth in growth technology ETFs. I hold mainly ETFs that are broad market based. Um, has accumulation of a couple hundred companies, and so far it's been working out pretty well for me. Um, I think I'll probably continue to do this for as long as I can. and hopefully retire at the age of 30 or younger. But by doing this, I've grown my money a substantial amount. Um, I have around $500,000 now. I started working when I was 15 and, saved a decent amount of money and, opened my brokerage account when I was 18. But that wasn't the best time to open it because it was during the time of COVID. And so it was 2020. Everyone was panic selling in the market. There were blood on the street. Uh, and I was shocked at how volatile the markets were. But I realized that the market was going down basically every single week for the past 2 or 3 weeks, or whatnot. And I was like, wow, I should try to profit from this. So I looked into ways to profit from a falling market. I learned about what puts were. I invested in some puts for, I believe, Starbucks and lost all my money because the Fed came out that same week and announced that they were going to start slashing interest rates. So everyone in the stock market started buying back in, because they were super excited about all this new money that would be entering the market. The money printer was officially turned back on, and there we go. Not a good time to be in puts. So I definitely lost a lot of money in those positions. Um, but it taught me a lot about just investing in general. It taught me that time in the market is more important than timing the market, and that's something that I want to just continue to remember until I'm old. I've been investing pretty regularly in the markets since then, and I've been investing in things that I want to hold for the long term. So things I truly believe in, which is basically just the entire market. And the S&P historically returns 8 to 10% every year. There are arguments against that. So one is that P ratios are too high right now. It's the highest it's ever been. And you know, while that is true, I think there is an argument for that. My personal outlook on it is if you look from a macro perspective, and I usually tend to analyze things from a macro perspective, the stock market has not been this easily accessible for since inception, pretty much. I mean, if you look 10 or 20 years ago, uh, and you look at the people investing in the stock market, there were probably a lot less players because of how difficult it was to invest, right? You had to call someone, place your order, you know, do this and that. But nowadays, everything is digitalized. There are a billion apps out there for investing in the stock market, and you can easily put your money into the market. So, you can invest using these apps. You can check your entire account balance easily. You can check your trades. You can look at the amount that your money has grown over time and the returns that has accumulated. And this would have been unthinkable, unfathomable, 20 years ago. And another argument is that AI is a bubble right now, and we're sitting in an AI bubble. Now, that's a decent argument. You look at the dot com era, you look at 2008 with the real estate bubble, and all of these things were devastating to people's portfolios. But I think there's actually a lot of potential in AI, and the AI kind of outweighs the risks. Just the potential of AI, I think, truly outweighs the risks. If you look at the dot com era, a lot of people lost a lot of value in stocks um, after people started buying too much and the price was too inflated. The bubble bursted, right? So that's kind of what happened in the 2000s. Um, but if you look at companies that are most profitable today, some of the biggest companies in America, Amazon, Google, Meta, these are all companies that are internet based, right? Everyone saw the potential of the internet. when the dot com bubble was at its peak, and nothing changed about it. They were true. Their thesis was correct that the internet would change the world. Now everyone works via internet. Everyone's entertainment is basically via internet. Everything's basically on the internet. And so these companies had time to continue to establish themselves, to continue to uh, develop their technology. And now look at this. We're at all time highs, way higher than the dot com, peak of the dot com bubble. And I think at the root of it all is the bubble, the underlying value of what the bubble is actually offering is higher than the risk of what, you know, of there being a bubble in the first place. And so if you look at where we are today with AI, sure, these valuations could be inflated, right? You see companies like Nvidia and CoreWeave and a bunch of AI companies basically funneling money into each other and propelling each other's values up. And while that is true, I think there's also a reason for that. And so, for instance, you look at data center companies, they hold chips for these AI companies, right? And when these AI companies develop a new chip, then the older models become almost obsolete over time. So, in a way, these AI data center companies are hedging the risk. They're the ones who are holding all the risk on their balance sheets. Uh, and you kind of need that, right? You need the AI data centers to be available for companies, to be available for the infrastructure of AI. And they're kind of like a trampoline for these AI companies to continue to develop and do research and boost their earnings without having to worry about the long-term effects of old technology being on their balance sheet, because it's all on the side with these AI data center companies. So once you understand that, you realize, okay, um, there's kind of a reason why multiple different versions of AI companies exist. And then you start to look at the actual technology, right? The underlying technology. What is AI offering us? If you told me 10 years ago that AI would be a thing and you explained what it was, I would not believe you. I would be so excited for the future because you're basically telling me that there will be a genie in the bottle for everyone's disposal. At everyone's disposal. Like, you're telling me that people will be able to do things more efficiently at incredible speeds with incredible accuracy. And that sounds like tremendous opportunity. And it is. And currently we're trying to figure out how to use it to the maximum potential. But if you think about just the compounded effect of investing in the market, you can correlate that to the compounded effects of AI in the future, right? We're going to continue using AI no matter what. And, most likely, right? And in 10, 20, 30 years, AI could help us solve some incredible problems like finding solutions to illnesses, finding cures, making things more efficient in terms of our infrastructure, in terms of our the way that society is set up, both economically, probably even politically, like just in all areas. I think things will just get more efficient, and it may be more complicated as well, but I think it will get more efficient for sure. So, it might get more complicated though. So, you definitely want to work hard. You definitely want to save your money. You want to build as much capital as possible so that you can put into the market and have it work for you. And you want to do that while the world is less competitive, right? So I feel like the world is only going to get more competitive over time. You want to take advantage as much as you can of just, right now, and where you can, you should work hard to to make money and just to get ahead. So definitely, there's a lot of potential in AI. I think the potential definitely outweighs the current valuations. I think the impacts will be unimaginable, really. And to be honest, if we didn't have AI, I wouldn't know how much longer the stock market will continue uh, to climb for. It's been a good run, but I think due to AI, the development and the innovation that is coming along with that, and just overall understanding the macroeconomics, where we are, what is going on in terms of technology advancement, innovation, things of that nature. I think overall we have a pretty bright future ahead of us. There might be a downturn in the near future, but I really truly believe that we're going into a golden era of investing. So I don't want to miss out on that. I'm investing regularly. I'm investing in my retirement accounts and my personal accounts, and I recommend everyone do the same. Because I definitely don't want to get left behind, and so I believe the only way to do that is to invest your money in the market, get your returns, and try your best to not freak out, not panic too much when the market starts going down, because it will inevitably, right? There are cycles, these things happen, and it's inevitable that again there will be another downturn. Maybe it will be a bubble, and or maybe another black swan event will happen like COVID. But during those times, the coolest heads prevail. People with capital prevail. You need to be brave, take advantage of the situation, and people who invested during those times made the greatest returns. So I'm definitely going to continue investing, but I'm also saving a little bit of money on the sidelines for situations like that. If it were to happen again, I want to be prepared. So yeah, I hope you guys will look into some of the compound interest calculators. I hope you guys learned something from this video, and feel free to calculate how much you'll need to invest and save to retire, to have your dream ideal amount of money. I'm really interested to hear that, and feel free to leave a comment below. Um, a like and a subscribe would definitely be appreciated as well. So yeah, thank you guys so much for listening and watching, and see you guys next time.